Airbnb coming off its second worst day of the year. Shares fell after KeyBank downgraded the stock to sector weight and raised some questions about future margins and revenue. Now, the analyst behind that call, Justin Patterson, KeyBank Capital Markets Managing Director, joins us now. Justin, it's good to see you. So Airbnb shares under pressure yesterday. The biggest factors, though, for your downgrade, what are they?
Yeah, it's a great question. So we downgraded the stock, like you said, and that's really just predicated on a slowing room night environment. Airbnb is coming off several years of pent-up demand, several years of great supply growth, and a moderating ADR price environment. The CEO, Brian Chesky, has even been talking lately about how pricing needs to come down. If you look at Airbnb relative to hotels, that pricing discount isn't what it used to be. So we think that when you roll that through the model, there's risk to revenue next year, and in turn, you just don't have the same degree of leverage you've had in the past. So we think consensus estimates are too high. The growth premium Airbnb gets versus its closest peer Booking needs to erode a little bit on the multiple, and that just makes for a range-bound stock.
And when you think about the average daily rate, now some of that has come down because of kind of wave of new listings from some of the releases that they've put forward and trying to get added number of hosts, whether that be short-term or long-term. So where has that also kind of played into that average daily rate that we're seeing customers opt into? Because now that you've got more supply, naturally there are different areas, different realms for people to look across their bookings, whether they want to stay in Barbie's dream house or Shrek's house, or whether that's just at, the apartment down the street from here in Times Square.
Right. So there's a lot of moving pieces in there, like you articulated. So paying for Barbie's dream house is going to be a lot more expensive than, say, paying for an apartment in New York. And when you control for those different factors, I'd say about half of that is Airbnb inflicted. So using price optimization tools in North America to bring pricing down. And then half of that is what you would call more apartments versus more whole houses within there. Going forward, we think that a lot more of that is going to be driven by property mix, so the trade down to lower price products, and then to some extent just moderation from this pent up demand wave coming to an end. We've had a lot of crowding into urban markets, a lot of crowding into Europe. We don't think travel's as strong in the next year, just given how stretched the consumer is.
Justin, when it comes to some of the ideas that we've heard from CEO Brian Chesky, did a recent interview with the Financial Times talking about some of those longer term stays, how that exactly fits in to their business plan going forward. How big of an opportunity do you potentially see this being for Airbnb in the long term?
It's a great question. It's a new use case that came about during the pandemic. The question mark is always just where exactly does that level off as a percentage of the entire business? Since if you look during the pandemic, this was consistently around 20% of overall room night growth. It's a very big number with people required to go back into the office these days. It's a lot harder to justify a large number of people being digital nomads, if you will, just traveling the world, living on Airbnb for 30 days, even 90 days at a time. So I think when you look at the core business, it's likely a subset of that, probably sub 10% over time.